Are you still saving up your 20% and watching home prices rise? Well, let's get down with the facts about buying with the minimum 0 to 5% down. We have Nicole Rueth here today, the Rueth team at Movement Mortgage, and she's a lending expert. So we're going to get all of her expertise on the facts about buying with less than 20% down. Thanks.
Yeah, no, thank you for having me. I love this topic because so many people think you have to save up to 20%, which you don't.
I know it's so crazy because we're in the biz, and so we would never think that you have to have 20% to buy a home. But I think it's still a very prevalent myth in the marketplace that people think that they need to save up that much. Now, the more you save up, you can get your monthly payment down. Like, that is a fact. Like, you might need to save up to try to get your payment where you want it. But just in terms of ability to get a mortgage and get into a house, you don't need the 20%.
Correct.
Yeah.
Absolutely correct. It is an overall budget. How do I fit the money that I have liquid to the budget that I'm looking for on a monthly basis to the purchase price that
Is available.
or ideal to your lifestyle?
Yes. Yes. So, all right. Well, let's just go through some of these loan types because each loan type has a different minimum amount down payment required. So let's just start with conventional. What's the minimum amount on a conventional loan?
If you're a first-time home buyer, it's 3% down.
Okay.
For a move-up buyer, or if you've owned a home in the last 3 years, there are some exclusions to that. If you've had a divorce situation and you were on that loan and you're now getting your new home, that the fact that you had been on that mortgage, you can still be a first-time home buyer. So there's some interesting exclusions. But typically, if you've owned a home within the last 3 years, or maybe you were even on title for your parents' home, that's a thing. So then that's ownership. Then you'd have to put 5% down.
Okay, so with a conventional loan, it's 3% for first-time buyers, and first-time buyers count as anyone who hasn't owned a home in the last 3 years. Some exclusions may apply. I feel like we need to add a little asterisk. Some exclusions may apply.
Exactly.
But if you're not a first-time home buyer, then 5% is the minimum on the conventional.
Yes.
Okay. How about FHA?
FHA is fantastic. FHA, you only need 3.5% down. Oftentimes we see FHA partnered with down payment assistance, which I know we can talk about. But 3.5% down is the minimum down.
Okay. And my favorites, VA loan.
I love VA loans. VA loans are no money down, and you can have more than one VA loan at a time. People don't realize that. So that's really an additional benefit. And you can buy 1 to 4 unit property still with no money down.
Now, the caveat, this is where it always gets fun having the realtor and the lender together, because the caveat to these zero down things is that you still need to have earnest money. So, you can't really have zero liquid money. You need to have typically at least 1% of the purchase price to give as earnest money. Although I have certainly seen offers from buyers where, the seller asks for a certain amount, maybe 1% or maybe more than that. And then a buyer will submit an offer with less than what the seller's asking. So everything in real estate is negotiable. But when that happens, those VA buyers, even though they can get in with 0% down, they have to have some money for earnest money, but you get it back. You end up walking away from closing with a check at title and getting your money back.
You can. But you do have to remember that there are closing costs, right? And that doesn't go into account with the zero down. So you'd have to have those funds unless the seller's paying it. And inspection. Inspection is outside of the loan versus the appraisal. We can roll it into the costs. So I agree with you. You have to have somebody say, and then you have to move.
The moving can be expensive. Like, whether or not you hire movers, every time I've moved, I'm buying boxes and bubble wrap and all the stuff. I mean, it costs whether you're hiring help or not.
Exactly. Even if you're not buying any new furniture, it's a new placement. It's the new setup, there's going to be things.
Mhm.
Yeah.
Okay, so the next one, which this is a loan type that I don't know that a lot of people have heard about,
Mhm.
partly because we're in Denver Metro, so there's not a lot of availability for this in metro urban areas, but the USDA loan.
Yes. Most people think of meat when they think of USDA, right?
Yes.
It's actually rural lending as well. And so we have it here in Denver. I mean, you can go to Morrison, which isn't that far, and you're now USDA. So it's really based on population. So I can go out to Morrison Conifer and Evergreen and be in USDA. I can go out to Western Plains. When you go south, it gets harder because Castle Rock has grown so much that between Castle Pines and everything else, it's really filled in. There's only a couple of areas, like, somewhat in between, Colorado Springs, Castle Rock, and then Denver that you can squeeze into, but it's so important that if you think you're not gonna be inside Denver, if you're, like, that person that says, "I want a little bit of space or a little bit of land, or I wanna buy a single family home for less money," right? You can go up to Dacona, or you can go up to some of the northern suburbs. I would go and Google USDA map,
Mhm.
and you can see it color codes it for you. It's beautiful and it's simple.
Well, we skipped over the news we were trying to provide, which was
Yes.
what is the minimum amount down payment for a
Look,
USDA loan?
0.
0. So exciting.
It is true. It's got a great interest rate, 0 down, and a very low. It does have a monthly fee associated with it. It's not called mortgage insurance, but it's got a monthly fee, and it's lower than even FHA.
Yeah, and as Nicole was saying, it is really easy to go onto that map and you can search up a specific address or you can move around the map and see like, are there areas where a USDA loan is available to me and I would be willing to live in those areas. So I've got somebody who is I think in Evergreen and she was saying that she thought that the property she was looking at buying count or qualified for USDA. So, um,
She should definitely take a look at it. The only downside to USDA, whereas I love VA has the highest allowed debt to income ratio, 0 down. USDA has the lowest debt to income ratio allowed of all the loan types. It is the most restrictive. You can't have any income producing aspects on the property. You can't have any outbuildings. So it's typically going to be single family, and it's a lower household income. So there's income restrictions
oh,
and debt to income. So you've got to work with a lender that understands the USDA because somebody could go, that's a great product, but if you don't realize how low the debt to income ratio restrictions are, you'll get excited and it won't fall through.
and then you get
Go through,
disappointed.
and then you'll get disappointed. That's
We
the
don't, yeah, that's what we're doing here. We're providing a lot of education to avoid disappointment.
Yeah, yes. But check it out. But absolutely check out the map, and then there you can also, search and Google USDA income limits, the same as you can with down payment assistance, CHFA income limits and Metro DPA limits. It's really good to know that because some down payment assistances, we can go up and over $200,000 a year in income, whereas USDA, you'll be a little surprised, I think, in how low the income limits are.
Yeah.
Yeah.
Well, and that's a great segue because I was thinking the next thing that we could talk about is some of these down payment assistance programs because you need your closing costs plus maybe 3% down, and maybe you're struggling to come up with that. But as a first-time home buyer or anyone who hasn't owned a home in the last 3 years, some exceptions may apply. Um, you could qualify for down payment assistance. So can you
Yeah.
talk a little bit? Like I know we have CHFA. There's grants and loans. Do you want to talk a little bit about kind of what programs are available?
Yes. Colorado, we have upwards of 38 different down payment assistance programs available, and they don't require you to be a first-time homebuyer. So you can there's several programs that you can still own another home. So that's really cool. And then there are some programs that are available that you can be buying a multi-unit. So you could buy a duplex and have rental income. So you've got to be able to structure it where you understand what the income limits are, which if I'm using rental income, it still has to fall inside the income limits to qualify you. But down payment assistance can pay for your down payment. If it can pay sometimes for down payment plus a little bit of the closing costs. And I'm really structuring it for 2 wins. Well, we'll say 3. One is when you need down payment assistance and you just don't have that kind of money saved up. And especially in this market, if you can get the seller to pay closing costs and you get down payment assistance, that's a home run. The other option is you have some money, but you don't want to be house poor after you move into the home. That's kind of one of those where if I look at this and I say, the amount of money you have in your savings account is exactly what your cash to close is, we should at least take a look at down payment assistance to leave you that ability to have some cash after closing. So there's nothing worse than being house poor. The third strategy that we use down payment assistance for is because most of them, not all, most of them have a fixed interest rate. And so if they have a fixed interest rate, as long as you have a qualifying credit score, whatever, anything up to or below or to that qualifying credit score, you will have this same interest rate. So you can have a 640 and get down payment assistance and have a better interest rate with down payment assistance. Even if you don't take the down payment assistance, you can have a better interest rate, have no money you have to pay back later than going with a straight FHA or conventional loan.
Oh, interesting. So do you typically, as a loan officer, check every file for the ability to use down payment assistance programs? Or is that something that people would need to specifically ask you to look at?
So a lot of people ask for it right out of the gate. I want to buy, but I don't have enough money. But other situations where they have a low credit score, we might suggest it and talk through the pros and cons in their certain situation. Or if they are right on the cusp of having enough money, but not quite enough, and they don't have the ability to get more. Like a lot of people today have a parent or have somebody in their family that would be willing to gift them money. That's an option. But if they don't and they don't have any resources beyond that, and they're right there and they're stretching themselves, we'll talk about it.
Now, it seems like Eric was telling me not too long ago that the Chaffa grant and the Chaffa loan, I think it's up to 25% or 3% of the purchase price or loan balance.
It
One of the two.
Yes.
Um, but that 25 grand grant or loan was only with an FHA, like you couldn't combine that with a conventional, I believe.
So what he was talking about, so it's 3% of the loan amount, and it's the grant versus the loan. So you have 2 options, and now Metro DPA actually allows you to buy the interest rate down. That's new. So they're definitely evolving over time. They evolve a little slower than the rest of the market, but the grant is with the FHA loans, and the or silent second. And the silent seconds are with conventional. So there are specific programs that are available for one or the other.
I was just gonna say we've been throwing around this silent second term, and we should probably silent second, what I think it is, so this will be like a quiz time, you can correct me, um, is a second mortgage that goes on your house. There's a lien on the house just like the first mortgage. It's happening all at closing. It's all happening at the same time. There now for these assistance programs that are giving this silent second loan, it's an extra up to 25 grand that you owe, but there's no payments and there's no interest unless you refi, pay off the first mortgage, or sell the house.
Yeah.
Yeah. So does that wrap it up?
Yeah, that makes it silent. So that's perfect because there's no interest accrued. There's no payment that needs to be made. It's simply if they're giving you $25,000, they're putting a lien on your home and it sits there and they want their money back at some point, and they put the terms of that is when you refinance or sell or pay off that mortgage.
Yeah, and it's so important if you take advantage of that program to remember that you took advantage of that program because I have certainly had some very surprised sellers who, if if I don't have title, pull an E&O early on in the process, and we wait until, and I just ask people, how much do you owe on it? And then I take their answer and I go with it, right? This is like a lender skipping over underwriting and being like, yeah, sure, that's fine. Yeah, so I've done that before. But then when the title commitment comes back after we're already under contract, so they've already agreed to sell the property to a buyer, and my estimate for what they're going to walk away with at closing doesn't include the silent second that's on there. And then we get the title commitment back, and I always review those. And so that's where in the past I've seen that pop up, and I've been like, oh my goodness, there's another however many thousands of dollars that needs to come off of the seller net proceeds at closing. And that's a difficult conversation to have when they forgot, and that happened a lot too when people were refining in the COVID era and not refining, loan modifications.
Yes.
There were a bunch of loan modifications in whatever era that part of what they did to modify the loan was like take a chunk of money off of that loan balance and put it on like as a silent second. So
Yeah, FHA will do that a lot, or really any of the loan modifications. They don't typically just wash that money away. They just add it to the end
right.
as a second or third lien.
Yeah, and I had sellers who, had no idea, claimed to have no idea that that's what was happening. So who knows? But definitely it was a place to improve my processes, right? And I'm like, I'm pulling this information up at the start.
Smart. That's smart move.
All right. So now, one of the big things about this 20% down business is people have that in their mind because we know that you have to have private mortgage insurance on the house if you don't have 20% equity.
Right.
So that's where people kind of started in with this thing, oh, we need 20% down because then they would not have private mortgage insurance. But I mean, there's options for that. And, sometimes it's not that much. Again, I just found out you guys are shopping mortgage insurance provider, like 8 different private mortgage insurance providers to find the best rate every time.
Every time.
Yeah.
It's an automatic cycle that it just grabs the cheapest one.
Yeah. And I've seen that come in at like only, I think, $48 or $50 recently. So it wasn't really adding a ton on to the monthly payment.
No, that private mortgage insurance, it depends on how much you're putting down. So it'll be more expensive if you put 5% down versus 15, right? So at each one of those levels, 5, 10, 15, it's based on a percentage, so the mortgage insurance factor. And that factor changes and gets lower the more you put down. It also can increase if you have a co-borrower. It can increase if your debt-to-income ratio is above 45%. It increases with a lower credit score, or it increases with a condo or a multi-unit. So there are situations, or investment property or second home, like because you can put 10% down on a second home or 15% down on a second.
So all of those same factors that are going into what a person can get for an interest rate is also, all those same factors are going into how much their private mortgage insurance might be.
Yes.
Gotcha.
Yes.
Now, with the conventional loan, I know that I think you can just call them when you think you have 20% equity and ask them to drop it off. And I'm sure they have a process for doing that that probably includes, desktop appraisal or maybe an actual appraisal. But what about with the FHA? Talk to us about when you can get that private mortgage insurance off of an FHA loan.
So FHA loans with a 30-year fixed, typically you're going to have 3.5 or 5% down. Those are going to stay with the loan for the life of the loan. There's only very few situations where an FHA loan MI can fall off. So the majority of people are going to have to refinance in order to get rid of the mortgage insurance. Now, we'll look at doing a streamlined FHA refinance versus flipping somebody from an FHA to a conventional loan. If they have enough equity and they have a high enough credit score, I'm always going to suggest that we take you out of the FHA loan and put you into a conventional loan to get rid of the MI or get rid of the MI soon.
Well, and also you have to be careful with that because if that silent second is on there and has to be paid off if you refi out of the FHA, that's a consideration.
It absolutely is if you're doing the down payment assistance. But there are situations that you'll want to stay in an FHA loan when you refinance. Your credit score is still low, your debt to income ratio is still high, and y'all have that mortgage insurance. The conventional mortgage insurance, just so it'll automatically fall off after you've hit 22% in equity based on your purchase price. Right. So they do have a little bit of a buffer on there, but that automatically, like every month, you're knocking down the principal, so it'll automatically come off.
So they have a certain date of payments made when they say, okay, now you have 20%. They're not even looking at market value compared to what you owe.
Not for the automatic. And if you make extra principal payments, that all gets factored in. It'll just come when that loan balance hits that magic number. But you can, as you mentioned, call up and start a process, which you have to pay for the appraisal, but it's a lot cheaper than a typical appraisal. And they'll go visit the home and they'll do a full appraisal for it to determine if the market has given you value or you've renovated it enough to give you value.
And they forced appreciation.
Forced appreciation. That's right. Then you can get rid of the mortgage insurance early.
Cool.
Yeah.
I think. Oh, well, no, there is more. But wait, there's more. So we're talking about ways to get into a house with way less than 20% down. And so, while we've talked about the minimum amount down for different types of loan programs, I think it also, and we've talked about down payment assistance programs, I think it also is a good idea to talk about gift funds, co-borrowers, and co-signers. Why don't you start off with the gift funds and how easy that is? I know there's a couple of different requirements on conventional versus FHA, but I mean, typically it's just pretty easy.
It is really easy. It is really easy. So you can get gift funds across the board from any family member.
Now, getting somebody to agree to give you the gift funds, that is the hard part. I don't want to skip over that and act like it's no big deal and everybody just has all this family that's willing to give them money, because I know that's not true.
Yes.
But if you are in the fortunate position of having someone in your life, whether it's family or somebody else, because it can be anybody, right?
It can be on certain loan programs.
Okay. So if they're willing to help you out, give you some money. Yeah.
Yes. The receiving of the gift funds is easy, I should say. That's a great distinction. So with FHA, it does require that we document the donor's capacity to gift. So we're going to get like a bank statement from them showing that it's their money, that they're transferring the money over to the borrower, right? And it will also come with a gift letter. The gift letter is a standard formatted letter that just simply says that the donor is gifting it to the receiver or borrower with no expectation of getting that money back.
And that's something that your processor draws up on a as needed basis and sends out. It's just so quick and easy.
It literally is in the doc set. So it has to have the loan number on it, and it is a formatted letter.
Cool.
Yep.
The conventional. Yeah, the conventional.
Yeah. It doesn't need to verify donor availability of funds. So we just get the gift letter, and typically I will have the donor wire the money directly to title. That way I don't even have to verify that it hit your account, that it's available funds or anything.
Right. So if you've got some gift funds, that could help you get in. What else? The co-borrowers and co-signers. So maybe to start this off, we just kind of clarify what is the difference between the co-borrower and the co-signer.
We have that conversation a lot, especially when there is a non-occupant co-borrower who might or might not want to be on title. So typically, in the sense, when I say non-occupant co-borrower, that literally usually means a parent, a sibling, somebody that is going to be on the loan but not live there. If you're living there as a primary home, your mom and dad aren't going to live with you, and maybe they are. But if they're non-occupant, then they're a non-occupant co-borrower, and then they, as a co-borrower, they would be on the loan and on title with you. And why does that matter? Well, if they're on the loan and you miss a payment, it's going to affect their credit too. Or if you're both on the loan, and something happens where you can't make the mortgage payment anymore, you're both 100% responsible for that loan. Mom and dad might have to sweep in and, help you sell it quickly, that kind of thing.
And it counts towards their debt to income ratio. So even though they're not even living in that home, the fact that that mortgage payment is showing up on their credit report, even though they're not paying it, can affect a co-borrower's ability to borrow additional funds for something else.
It absolutely can. The only way around that is after you as the borrower have been making your payments for 12 months, then the lender helping the non-occupant co-borrower, not to get this too complicated, but if mom and dad helped you buy the home and mom and dad want to go buy another home themselves, as long as you've been making the payments for 12 months, they can get 12 months of bank statements from you to exclude that payment from their debt to income ratio. But for all intents and purposes, it is sitting on their credit report. It is counting as an expense for them.
Well, and it's also counting as an asset for them because didn't you say that the co-borrower is also on title?
So exactly. So the co-borrower is on title. You would only one of you would count it as like the mortgage interest deduction or paying capital gains on it. You're not both going to be double dipping on the taxes. So you're not both going to be looking at it necessarily as an investment or an asset. But the ownership carries other situations that need to be discussed. So as being on the loan, you're helping that person, those non-occupant co-borrowers are helping you qualify for more. But they're also responsible for paying the loan. On title, they have the ability to make a decision. So you can't sell or refinance without them signing off on it as well. So they have the ownership rights to determine what happens with that asset, even if they might not take part in thinking about that as being part of their net worth.
And they may not live there,
Yep.
Yeah.
But they would still have the ability, and this comes into play. You see it a lot with, divorces or breakups. That other person has to sign, who's ever on title. But we have parents who want to help with the loan, but don't really want to be a part of the decision making with that home. And so they'll just be on the loan and not be on title, which makes them a cosigner.
Well, yeah, and that brings us right back around to the difference between the co-borrower versus the co-signer. So now say that one more time, like what's the difference that makes it the co-signer versus the borrower?
So if they help qualify and they're responsible for the loan, they signed on the loan paperwork, but they didn't sign on the title paperwork. So they're not on the deed owning. They have no ownership in the home.
And they have extra trust in the person living in the home.
Yeah,
It's a lot of trust, I think, to put in somebody to say, I'm willing to, go down with the ship and have this on my credit report so that you can do this. And, but I'm not going to be on the title. Like I have absolutely no rights, no decision making. Yeah, it's a lot of trust that a cosigner puts in someone. And I think you're right. I think it's often parents.
it is.
Whether or not the trust is earned or
That's right.
should be there, that's a therapy show. That's not on the real estate show.
Not a real estate site. But we do see the opposite where we'll see people go on title if a parent wants their kids on title, a spouse, maybe one of the partners could not be on the loan because of credit, or maybe they don't have a job right now and they have a lot of debt. So we'll always ask if that person wants to be on title and have the ownership rights.
Yeah. Okay, so I think we did it. I think we covered all of the facts that are important things that you should know if you're going to buy a house with less than 20% down, because we want you to know that that is possible. And so hopefully we shared enough information that some more people hop off the fence and decide to do the application and upload their docs and figure out what is possible for them.
Yes.
Yeah.
I love it.
It's exciting.
Yeah. The answer is yes. It's just a matter of how long and what does it take to get there.
Whether it's now or later.
That's right.
That's right. All right. Well, all these wonderful facts have been brought to you by Nicole Ruth, the Ruth team at Movement Mortgage. Thanks so much for being here today, Nicole. It's always fun to have you on and get so much good information from an expert in the field. So thank you.
Oh, I loved it. Thank you.
If you like this content and want to support the channel, don't forget to hit the like, subscribe, and alert bells before you go.